Hello, welcome back to this course on understanding financial frauds and ways to detect it. In this the last video, we understood the cost, the definition of financial fraud. In this video, we will attempt to understand them in a bit more details. So, the financial fraud is falsification of or the alteration, manipulation of material financial records supporting documents or business transactions. So you may be doing only the accounting wrong, you may be changing the documents itself, or maybe misrepresenting the business transactions in a way to deceive users from the material information. Now, the materiality concept is very particular in audit. The materiality means that the amount of the volume of the transaction, or the amount of the transaction should be that it's leading to the another decision. For example, if the total revenue is $1 million, a financial fraud or a misstatement of a couple of $1,000, maybe $10,000, would not make a lot of difference because it's not even 1% of the transaction. So it's not going to make is not a huge amount, and the materiality is not there. However, however, if let's say the falsification of even $10,000 will turn the company from being in losses to the profits, then it will be considered as material, because the way the company's financial statements are being seen is very different. One way, you are if you are turning from losses to the profits, then it's a different ball game together, because you are changing the materiality aspect. The way investors make decisions is going to be changed. The ratios will change. If you are moving from one account to another account, even in minute details, but it may be done in a way to impact the ratios, to bring them in within the line or within the contractual terms. Let's say the bank terminate the bank agreements, stipulate to keep a 2 to 1 debt equity ratio, not more than that. So if doing slight adjustments into the retained earnings, or to the denominator or to the nominator, may impact the debt equity ratio, or maybe it's low, maybe it's higher. You want to bring it within the two. So basically, what you are trying to do is you are trying to convert a situation from a non-compliance to compliance part. So that will be material misstatement. So then each and every case is different. There is no definition of what is material. For certain companies, 5%, 10% can be material. For certain companies, it may not be material at all. So you have to be it has to be understood case by case. Now, the other way of the financial fraud was omissions. So material and intentional omissions and misrepresentation of events, transaction, accounts, or significant information from the financial statement when they are prepared. Deliberate misapplication of accounting principles and policies. For example, depreciation policies, inventory policies, borrowing cost policies, in implementation of international accounting standards. When you are deliberately misinterpreting them and trying to implement the learnings from those IFRS or US gaps or UK gaps or whatever accounting policies and principles the company might be following, if we have done the deliberate misapplication of those, it will be considered as financial fraud. Intentional omission of disclosure or presentation of inadequate disclosures. Every US GAAP, usually the US GAPs or IFRS or IAS, they have certain listed down the disclosure requirements, and the conceptual framework of the accounting standards also states that you don't everything is not defined in the accounting standards. Some disclosures have to be made beyond accounting standards if it helps the user to understand the accounting transactions or the financial statements in a bit more details and in a more useful manners. in every industry sometimes also have their own accounting standards or their own way of disclosing the information to that particular industry. And the reason being is that every industry is different, every company is different, and business transactions are different. So the it's the job of the management to present the information to the users of financial statements in order to understand them and make the investment decisions with the proper information. Of course, there is has to be a prudent way that you are not divulging the competitive information about the company, which may hurt the company in the long term. But the material the information has to be presented in a way that it does not divulge the competitive, but gives the user adequate information to understand the financial. You will notice in the financial statement sometimes you don't get the details of, let's say, for a very simple reason, account receivable. So you may get the provision of accounts, right? Provision of doubtful debts, but you don't know how many year old are they. Maybe they are 3 year old, 4 year old, 1 month old, 2 months old. Over nowadays, the companies are starting to represent they are overdue or not overdue, right? So you have some basic information, but not the detailed information about the aging. So certain companies now, maybe the investors may want to ask for more details to understand really are they recoverable or not recoverable. That is the job of financial analysts and auditors to make sure that the information provided in the financial statements is accurate enough and correct and in accordance with the generally accepted accounting principles. That is about the financial statements